It's never too late to start investing. There's no age for that. However, the earlier you start, the more fruitful is the result. And if you're a first-time investor wanting to invest but you don't know how to start your investing career, allow us to introduce you to 5 basic ways to invest your money. Hey go-getters, welcome back to The Early Investors, another profitable episode where you can learn how to become financially free. In today's video, we'll be showing you 5 basic ways to invest money in 2021 for beginners. Want to become the next Warren Buffett? Stay with me to find out all the tips and tricks to save your hard-earned simoleons. Before we jump into the video, make sure to subscribe to our channel for more business-related content. Let's analyze each investment option based on these 3 parameters that are liquidity, risk, and returns to really understand what happens to your money. So, what are these 3 parameters? Let me explain. Let's just say that you have an emergency and need immediate cash. Liquidity is defined as how easily you can get your money back from that investment. And risk is nothing but the possibility that you'll lose your money. Returns are how much your money grows. In the form of cash, all of us like to save money. Liquidity in cash is high because it's right there when you need it. The risks are low. It's not zero because you can still steal your cash from someone. And the returns are adverse. See, it's not going to grow if you leave your cash in your locker or under your mattress. Item prices will rise, inflation will take place, but your cash will remain the same, which is why cash returns are negative. Now that you have the basic understanding, let's move on to the 5 basic ways one can invest. Number 1. Savings account. A savings account is a simple bank account that allows you, while receiving interest, to deposit money and withdraw money. Withdrawing money from a bank is really convenient, but we also get tempted to spend, which is why long-term investments become a challenge with a savings account. Liquidity is high because anytime you like, you can take out your cash. Each bank, however, has a fixed number of financial transactions that you can do every day. The chance is 0. If you choose a reputable bank, your money is safe from the bank, yet there are poor returns. In the savings account, SBI has an interest rate of 3.25 to 3.5%. Pick a bank you like or trust the most, walk into your nearest branch and they'll help you open your savings account. Number 2. Fixed deposit. A fixed deposit is when you give a certain amount to a bank for a certain time, i.e., you will not touch this money until this period ends, and you will get a higher interest rate than a normal savings account in exchange. SBI FD interest rates, for instance, vary from 4.5% to 6.25% depending on how long you invest your money. Do you give it for 7 days, 3 years, or 10 years? The higher your tenure, the greater the interest you'll get. Coming back to the parameters now, liquidity is medium, so you can't liquidate your FD online because there are several banks. Plus, you have to pay a penalty charge if you withdraw your cash before your maturity expires. The risk is 0. After your maturity ends, the bank has to refund all your cash along with interest. Returns have been limited. Depending on the bank, it is about 4.5% and 7% and how long you give your money. But monitoring is the biggest issue with FDs. Suppose you can save Rs 1,000 for 1 month and save Rs 2,000 for another month. Then you need to start 2 new FDs. So you have to start a new FD each time you save, and it becomes hard to track all of these FDs. But we have something called the recurrent deposit to fix this problem. Suppose it's possible to save Rs 3,000 per month. So, Rs 3,000 will go to the deposit each month. But there's only one recurring deposit you need to keep. If you skip your monthly recurring deposit payments, you will have to pay a penalty charge. In comparison, your money would be secure, but the issue with FDs is the fines you have to pay if you withdraw your sum before maturity or if you miss your monthly payments. Then, all you need to do is set up an FD, is to use net banking or just walk into your bank branch if you are okay with these drawbacks. Number 3. Health insurance. Existence is unforeseeable. Tomorrow, if God forbids you to suffer an accident or recover from an injury, then the bells from the hospital would be insane. You do not want to beg for money in such a situation and spend the rest of your life in debt. which is why health insurance becomes so important. The risk is zero, and whether it can save your life or it can save you from debt, the returns are massive. All you have to do is pay Rs 4,000 to Rs 8,000 per year, and a total of Rs 2 to 5 lakh will be covered to pay your medical bills depending on your policy you take in exchange. Many websites can help you compare health insurance to find the best health insurance, such as Policy Bazaar, CoverFox, and many more. All you've got to do is call the executive, and they'll come to your office or your house to get the registration done. Number 4. Stock market. The stock market is risky. Some people have lost everything in the stock market, but some people have become very wealthy in contrast. As the name suggests, the stock market is a market where you can buy and sell publicly held companies' shares. It will be your job to analyze which business in the future could do well and then place your bet by buying shares of that company. Therefore, the stock market risk is high because you can lose your money if your analysis is wrong and the company does badly. Liquidity is moderate because it will take about 2 to 3 business days to return your money. But the returns can be very high as well. Warren Buffett, the world's 3rd richest man, generated his wealth through long-term investments in the stock market. Number 5. Mutual funds. The stock market is a one-person exhibition where all the decisions must be made. But the mutual fund is teamwork because it receives money from people like us through a mutual fund. Rs 500 from me, Rs 500 from you, and a pool of money is formed. A fund manager then uses this pool to invest in stocks, shares, and other assets. We don't have to think about where it's being spent because it's taken care of by the fund manager or a 0.05% to 2% fee. You can invest it on a one-time basis or start an SIP, systematic investment plan, where you can move a fixed sum to the mutual fund every week, month, or a quarter of your preference. A whole lot of mutual funds are available. Some are good for short-term investments, and some are good for long-term investments, which is why the duration varies from low to high. And it would take you 1 to 3 business days to get your money back in general. Nonetheless, if you invest in liquid mutual funds, then you can automatically get your money back. Risk mutual funds are subject to market risk. Please read the offer document carefully before investing. Mutual funds are associated with a little bit of risk, but as long as you do your homework, you should be fine. And the returns are average. On average, yields have been between 7% and 14% in the past. A liquid fund is a low-risk, medium-return mutual fund that invests in low-risk bonds or debt securities rather than high-risk shares. The ICICI Prudential Liquid Fund, which has been around for the past 13 years and has earned approximately 7.2% returns on pain, is one such example, marginally more than the returns of an FD. It's only lost money for 2 days in the last 13 years, so it's not very risky. So, these are the 5 basic ways that you can invest, but how you invest totally depends on your requirement and needs. But all of your eggs should not be kept in one basket, which is why you should break your investments like this. Next, you can keep about 20k to 50k INR for your monthly costs in your savings account and keep some liquid cash handy. Next, maintain an emergency fund, which is your paycheck for 2 to 3 months. Select a low-risk, medium-return investment option for your emergency fund. So, if you do not want to pay any missed fees and want an immediate withdrawal, you can either choose an FD or invest through Easy Plan. For any short-term investments, you can need it. After that, if you still have money to spend, select a mutual fund that provides high yields or invests in the stock market at high risk. You can only spend money in this third group that you don't need instantly and are alright to invest in for the long term. This is just a suggestion, of course. Ultimately, with your capital, only you can decide what you want to do. That's a wrap to this video, hoping that these tips will help you in your journey towards success. We are damn sure that today we nursed you to make some shrewd decisions. Let us know which investment plan suits your needs, and if you have any doubts, please leave them in the comment section. But before you make a move, don't forget to smash that thumbs up if you've liked it. Until next time, investors,